Welcome to our webinar all about 2025 recap and looking towards 2026. My name is Michael Clark, certified financial planner. Thanks for joining us. And again, we're just going to provide some tips for how to maximize your retirement in 2025. But we do want to first look back on 2025 as a whole and just see how things did. Now, these are traditional ways of investing or indexes. So it's a nice way to kind of look at, hey, how did the market or how did various investments do in 2025? Well, bonds tend to be on the conservative side of things, and those were up 7% last year. US stocks, those were up about 18%. When you look at US stocks, that tends to be the S&P 500. So think of it in terms of the 500 biggest stocks in the United States. And then international was up about 31%. So think Taiwan Semiconductor, Nestle's a big international company. There's a whole handful of, you know, car manufacturers that we like to think of in terms of international investing, but that did really well last year. So when you look at it as a whole, most of the time when you invest for either retirement or really investing in general, you tend to have exposure to all three of these markets, either some of it or maybe one or two. So most people, though, hold what's called a diversified portfolio, meaning you're going to have sections of your portfolio in all three of these areas. So last year, again, 2025 was a pretty good year for investing purposes. Now, looking towards 2026, I want to provide three tips. And these tips can be used for if you're in the accumulation phase. So if you're still saving for retirement, or if you're in the income phase of life where you're taking distributions from a retirement plan. And my first tip is to control the things you can control. There's a lot of things that we don't have control over. So you can see this chart lists some things that are in your complete control, some things you have some control over, and then other things that you don't have any control over whatsoever. So we want to focus more on the things that we can control and less of the things that we can't control, like stock market returns, taxes, what's going on in the news. I know it can be fun to talk through, gold, silver, cryptocurrency, things like that. Those are fun topics. But when it comes to accumulating wealth and ultimately having a successful retirement over a long period of time, we need to focus more on the things that, again, we can control. So we have complete control over those purple circles. Budget. We can control how much we're saving. We can control how much we're spending. We can control when we access the Social Security system. So we have control over that in addition to how much risk we're taking with our investments. Are we taking on a lot of risk? Do we have a lot in one of those markets we looked at already? US market, international, bonds, or are we more evenly distributed through them? Then there's areas we have some control over. So think of longevity. You can't control your longevity completely, but you do have a little bit of control over your lifestyle. And then again, some control over when exactly you retire. Sometimes you might be forced to retire for various reasons, but for the most part, you have a little bit of control over when you actually stop working, or to put it more specifically, when you make the transition from accumulation phase to distribution phase. So again, we want to focus more on the things that we can control and make sure those are optimized when it comes to our retirement. Again, whether we're accumulating money or in the income phase, we want to make sure we're spending our energy on things that we can control and less energy on the things that are completely out of our control. My second tip for 2026 is to learn about some investments. Now, these investments or strategies might be of use to you, but they might not, depending on the type of investments you have and the stage of life. And for this section, it's not to become an expert in these three areas. It's more just to tell you a little bit about why they've gained a lot of popularity and maybe if you should get more information about it. So the first one is something called direct indexing. Now, it is a way to invest and you're going to get an index return. So just for ease, we'll go back to that initial chart and we're going to say we'll track the S&P 500. So direct indexing is a way to get market exposure, or last year you would have earned about 18% in the strategy. Meanwhile, you're generating tax losses. So last year you would have earned a gain, but you would have been able to generate some loss. And this is just strictly with non-retirement assets. So think brokerage accounts, investment accounts you might have. Again, not IRAs, not 401ks. So again, we're talking about non-retirement assets. Now, all that sounds good, and I'll explain why that happens. But again, direct indexing gives you, or pretty close to it, the index return. So in last year, it would have been up 18. If, however, the index is down 10, the goal of the product is to be down 10. It is not trying to beat the market. It's not trying to do, pick and choose. Is Pepsi better than Coke? It's just saying, hey, we want to get the exact market index, which a lot of investments do this. There's index funds, there's a couple other different products that, again, track the index. But the way that this one works, direct indexing holds the individual stocks inside the portfolio. So you don't have to buy all 500 individual stocks to get the exact return, but you do have to buy a bunch of them. And conceivably, again, going back to the 18% return from last year, we all know the market didn't start off at zero and then just gradually make 18%. The market goes up and down, and within those 500 different stocks, things zig and zag at different times. So, what direct indexing does is it takes the ones that lose money. So, let's just say for ease, we have Coke and Pepsi in the portfolio. Well, maybe Pepsi isn't doing that well. So, the portfolio would automatically sell Pepsi at a loss, capture that loss for tax purposes. They'd then go buy Coke for 30, 31 days, and then they'd move back to Pepsi. So again, they'd capture that loss, but they would maintain the overall exposure or market risk to gain or lose that index return. So direct indexing is a way to get market exposure while capturing losses. And again, it's for non-retirement assets. So if you're looking for ways to reduce your taxable income, maybe you have a big tax thing coming up in the next couple of years. Maybe you're inheriting money, maybe selling a property, selling a business, something along those lines. Then direct indexing is a way to capture some loss that, again, you could use to offset future income or current income, depending on the type of the income. And there's a little complexity here. But again, today's just to kind of learn that, hey, direct indexing is out there. Technology has made it a lot easier for folks to do this, and the minimums are now a lot lower than they used to be. So something to look into if, again, you have non-retirement assets and you're looking for what's called tax efficiency when you're investing. Next thing would be structured investments, and specifically structured income notes. And again, we'll stay with the S&P 500 example. And a structured income note, again, structured investments, they earn a set percentage. So we'll just say for ease, 8%. So that investment or whatever's in the structured note earns 8% per year, as long as the S&P 500 doesn't drop -30 in a lot of cases. Now, each one's a little different. that a lot of them are -30, some are -40. So as long as this number that I circled isn't -30 or worse, then you receive your 8%. So good times, slightly bad times, you don't really care. You're getting your 8%. So just some examples. Let's just say the market's up 18% like it was last year. Well, your structured note would have paid 8%. Market's down 10%. Well, you'd still earn your 8%. The only time that you have anything bad happen to you is if the market drops more than 30% and then you stop receiving your 8%. So again, these are structured income notes, and I more just wanted to tell you about it conceptually. This might make sense for you, but again, it might not. Because again, if the market's up 18 like it was last year, this only earns 8. Again, there's various ones, some earn less, some earn more, but that's generally how those work. But there's a certain level of protection that is usually up to a certain point in structured investments. So it is a nice way to get a return unless we have an extreme market downturn. Third thing for 2026, or I'd say what's gaining popularity over the past couple of years, annuities are certainly coming back into favor just because they generate a guaranteed income. And I always tell people annuities guarantee something. So they guarantee either an income stream in retirement, they guarantee this thing called a death benefit, meaning if you pass away, a certain amount is going to go to your beneficiaries, or in some cases, they guarantee a long-term care benefit. So something used for health later in life. So they have a guarantee associated with them. There's trade-offs with anything. So again, annuities definitely are gaining more popularity, but I would say these are three of the more popular additions that we've been seeing a lot of people add and a lot of people ask about. So if you haven't learned about these, if you haven't looked at them, again, direct indexing is for non-retirement assets. Structured income notes work for either retirement assets or non-retirement assets. And then annuities can make a difference in terms of if you're looking to guarantee income in retirement. And again, it's going to be right for some and for others, probably not. The other thing I want to talk to you all about was something about just withdrawing money in retirement. So I get that question all the time from clients and folks in our group retirement plans. How much can I take out of my retirement accounts? So I know this slide's a little bit busy, but it takes withdrawal rates and it says, on average, when do these people run out of money? So the far left, and they just use a nice friendly number of $1 million. But if you have $1 million and you withdraw 4%, 5%, or 6%, you can see roughly how many years in retirement your money is going to last. So at 6%, or on $1 million, that'd be a $60,000 distribution per year. You run out of money somewhere, year 21, 22 on average. The 5% withdrawal rate, a lot safer, gets you to just under year 30. So again, this is for a 65-year-old. So looking at running out of money like 94, 95. And then a 4% withdrawal rate gives you a good amount of certainty that you will not run out of money or you'll never see your account value go down to zero. Again, not necessarily a guaranteed thing. This is just more, hey, on average, a 4% withdrawal rate is much safer than a 6% withdrawal rate. Does that mean a 6% withdrawal rate will not work? No, it could, but we need to have some sort of positive market during that period, or we need to use some products to maybe guarantee that type of income. So again, the risk of running out of money doesn't present itself in your mid 80s. We want to try to plan for a little bit longer than that. So just understanding, all right, well, how much can I withdraw? And what are the issues with going over that amount? Because again, it leads to running out of money later in life. So just something to be mindful of, especially if you're planning or if you're a couple years away from possibly transitioning from accumulation to income in retirement. Last thing I want to talk about along those lines, especially for the people that are getting close to retirement or again, making that switch from income from a job to income off your investments, is to be mindful of the type of account you're withdrawing from. I know this slide can be a little busy, but it lists all the different types of accounts and whether it's taxed, whether it's tax-free, and then if it is taxed, does that tax affect Medicare? And does that tax affect Social Security? Because again, those are all linked when it comes to taking income in retirement. And one thing we want to be really mindful of is just to have different sources of money that we can access at different times. I think we've all heard diversify our investments, don't have all our eggs in one basket. And we think of that in terms of practical investing advice. And there's some merit to why that's such a long-term piece of information. But a lot of times we fail to diversify our future taxes. And so by having money in different types of accounts, such as a health savings account, such as a Roth, such as a pre-tax, we are diversifying our future taxes. And I think a lot of times we forget that while we're accumulating money. So we want to make sure we have different types of money for different periods in retirement to then allow us to strategize for not only income tax, but the effect that it could have on, again, Social Security and Medicare premiums. So we want to make sure all that gels and we have options when it comes time to, again, transition from income from a job to income from our investments. Now, I do a lot of these workshops. If you have ideas for another topic or anything you'd like to hear me speak on, I could either send you some resources on it. We have a whole slew of resources behind the scenes. And then if you have a topic you'd like me to potentially weave into a webinar or one of our workshops, please let me know. Next workshop is on Tuesday, February 24th. It's at the Winter Park Library. So we have a partnership with the Winter Park Library where I do a series called Dollars and Cents. And on February 24th, I'm talking about income, taxes, and then charity. So all those are definitely linked, especially relating to what we talked about today in terms of the topics that relate to moving from retirement or moving from a job into retirement. So again, if you have questions on anything we talked about, so again, we talked about the things you can control. Again, there's some things completely in your control, some things out of your control. We talked a lot about different products and things that we're starting to get a lot of questions on, direct indexing, structured income notes, annuities. And then we had that conversation on not only taxes in retirement, but also a safe withdrawal rate. Here's my contact information. Again, if you have any questions, if you want to let us know about any workshop ideas that you might have, or again, you want to pick my brain about any sort of investing topic, feel free to let me know.